Hi everyone, welcome back to the 1% Common Sense channel. By now, you would have heard the new mortgage rules announced by the federal government few days back that included number 1, increasing the mortgage default insurance limit to $1.5 million from $1 million for self-occupied home, and number 2, expanding the 30-year amortization limit that include first-time home buyer buying all types of home and existing buyers buying newly built home. These changes are to be implemented from 15 December 2024. By now, you would have also heard all the noise and the popular videos explaining you the good, bad and ugly implications of the new rules. The 99% way. The 1% richest of the world truly understands the political, financial and economic system around them and uses it to their advantage. They only worry about things that they can control and how best they can make out of the situation. We all know that negative sells, but that's for 99% of the population. The 1% club always buys negative when it's in value. Remember this, the 99% sells negative, whereas 1% common sense buys negative. Through today's video, we will uncover what's the deal out of the new mortgage rules and what you should do the 1% common sense way by looking at number 1, why such measures, number 2, what's in it for you, and number 3, how best you should make out of this situation. Let's dive in. Number 1, why these measures? Canadian federal government surprised the market by announcing new mortgage rules. Along with the US Fed announced larger than expected rate cut of 50 basis points. The real question is why such measures these authorities had to take that surprises general population. There are 3 reasons for it. Number 1, Canada and the United States are at the increased risk of unemployment getting out of the control. The economic slowdown along with the risk of automation and AI, which looms big on IT, finance, marketing and operations job, could further increase the unemployment, at least in the near term. On the inflation front, if you really drill down the number, you would realize that the items which were in the control of consumer to spend money on, such as passenger vehicle or travel, have seen reduction in the spending. Whereas the items which were not in the control of the consumers, such as mortgage interest cost, rents, insurance and gasoline, were contributing to higher inflation in the recent past. These two, by the way, are on their way down, which will further decline the inflation. Number 2, in Canada, more than 45% of the mortgage outstanding are up for renewal in next 1.5 years. And high interest rate, along with high unemployment rate, is surely a recipe for economic disaster. Number 3, it's no secret that Canadian real estate market represents the larger share of national economy and household wealth. As a share of GDP, real estate industry and ancillary industries contribute to more than 20-25% of the GDP, highest among any G7 countries, and more than 40% of the wealth of the Canadian is tied to real estate. Hence, let's face it, Canadian economy is extremely dependent on real estate and immigration, and no politician or central bank leader would want to ignore it and hamper its economy and welfare. Knowing this well is extremely important for you in your wealth creation journey. Number 2, what's in it for you? There is no outright good or bad in any policy measure as it has been shown in the news or popular social media videos. It's always good for somebody and not so good for the others. Here's my take on that and what's in it for you. So the first measure, increasing the default insurance mortgage limit to $1.5 million. What's the implication of it? It's definitely positive for the self-occupying homeowners who had the income to qualify for the home but did not have the down payment to make up for it. Fact of the matter, semi-detached, detached or the properties where the basement could be rented were mostly above the range of $1 million in most part of the GTA. But also note that this segment of the potential home buyer is a very small proportion of the population of the home buyers. Remember, the 1% common sense dictates cash flow is the king. And let's face it, we all were facing increasing cash flow crunch due to increase in interest rates and higher living expenses. The increasing amortization period along with reduction in interest rates will go a long way to give some respite in the cash outflows. Hence, it is good for the disciplined home buyers who would use the additional cash to invest productively. The additional cash flow should also help in moving the wheels of the economy in the short to medium term, where this additional cash flow might be invested or spent by the end users. If you are following this channel, I would encourage you to invest this additional cash flow to make the most of it. As I've described in my 6 easy step financial plan video, the common practice is to focus on spending rather than on investment. In this case, the news and the social media is bombarding end users on considering the implication of high interest costs over 30-year amortization period without even realizing that there's other side to it, the investment opportunity. But here is my take on how 1% common sense dictates how you can make the most of the situation by looking at the investment perspective rather than focusing on the spending. We are not going in the topic of renting versus buying a home, which is a different topic for us to cover in a subsequent video. But assuming you were anyways considering buying a home, here is an example of how you can make the most of it. Let's look at an example of benefit of increasing amortization under the insurance category. Suppose you buy a home worth $900,000 with a minimum down payment of $65,000. With insurance premium, your total mortgage outstanding will become $868,000. And at the current interest rate of 4.39% for 25-year amortization, your monthly payment will become $4,773. The total lifetime interest cost on this 25-year mortgage will work out to be about $563,000. The same home which you bought for $900,000, suppose you opted for 30-year amortization with the same interest rate of 4.39%, your monthly payment goes down to $4,343, a decline of about $430 a month. Obviously, with opting for 30-year amortization, your interest cost goes up substantially from $563,000 earlier now to $695,000, an increase of about $131,000 over the lifetime of the mortgage. But here's the sweet spot. If you're able to disciplinedly invest this $430 a month which is saved up by paying less monthly installment into equity ETF for 30 years at 8% per annum, you'll end up creating a corpus of about $639,000 at the end of 30 years. Even if I subtract the increase in interest cost of about $131,000 out of this $639,000, you still end up having almost more than $500,000 saved up for yourself. You could see increasing the amortization period would be bad for those non-disciplined buyers who could not invest the additional cash flow they saved up in the monthly payments, and thereby they'll end up paying higher interest cost over the lifetime of the mortgage. The results are identical under the non-insurance category, where you'll invest the excess monthly cash flow which you will save up by opting for 30-year amortization. In this case, your corpus you will garner at the end of 30 years will increase to about $420,000. To achieve this level of wealth creation, following are the 3 simple steps you must take. Number 1, only buy the home which you could afford to buy at 25-year amortization. Number 2, opt for 30-year amortization. And number 3, disciplinedly invest the additional cash flow you saved up by paying less monthly payment for 30-year amortization into the equity ETF. You should actually set up a monthly automated payments into these equity ETFs, and thereby you would end up paying yourself first, and slowly and steadily you will push yourself to the 1% club, and like that the 1% richest of the world makes most of the situation around them. With that, I'm signing off. Please like, share and subscribe to my YouTube channel. I hope to see you all next week. Until then, take care.